All right. Welcome to the Happy Hour Money Podcast. And today it's just me and Wes Gray. No Josh. He decided to slack off and not show up. So we're going to talk about value investing and have an expert here with Wes. So Wes Gray is CEO of Alpha Architect. He holds a PhD from the University of Chicago, served as a captain in the Marine Corps, and his counterpart, Jack Vogle, joined us for a conversation on momentum earlier in the podcast. So definitely check that one out. I know it was well received. Wes, similar to Jack, has written a ton of stuff about value, momentum, and it's helped both Josh and I learn a ton. And so, Wes, thank you so much for being here today.
Yeah, honored to be here, Isaiah. Appreciate the invite.
Yeah. So one of the things that stuck with me from when we first connected, and it's been a number of years ago, it was through Twitter is originally how I found you all and your team. And it's been awesome because you put out so much good content. And one of the slides that I remember that I really liked, it was kind of you leveraging the Marine Corps, those days and like value investing or like factor investing. And so I wanted to kind of start there and how you think about the correlation of either like investing in that world or like how you would think about the two.
Yeah, sure. So kind of a fundamental principle of long-term investing is this idea that there is no free lunch. And there's this concept of no pain, no gain. And in the Marine Corps, there's a thing called extreme pain, extreme gain, which is just, permutation of that saying. And so I think all of investing, whether it's value investing, fixed income investing, really any form, it's really important that if you expect to earn some sort of like higher return or get a better benefit, you should be able to identify the associated pain, because anytime you're interacting in a marketplace, you're obviously buying and selling with other people. And if you expect to, get sold something in anticipation of earning a higher benefit, you probably want to be cognizant of why that might be the case. Otherwise, you might be on the losing end of a bad idea. And so no pain, no gain, extreme pain, extreme gain. That applies to the Marine Corps with respect to training to prepare for battle and set expectations, just like it would apply in the investing marketplace.
It's perfect. And I know, again, you've literally, people say, oh, they've written a book. It's like literally written the book on value investing. But if you had to describe kind of quantitative value investing at a backyard barbecue, like how would you describe that to someone that's trying to figure out, like, what does that mean, Wes?
Yeah. So the first thing I would do is explain to them a little bit of context. Because whenever you say value investing, everyone's a value investor, right? That essentially means trying to buy stuff that's cheaper than it's worth. And you've got kind of the stock picker flavor, like your Warren Buffett's out there. And then you have your quant flavor, which is more like us. And so when you talk about quantitative value investing or systematic value investing, it's basically just trying to buy cheap stuff that once we've identified the cheap stuff, let's try to get the highest quality cheap stuff. Okay. That's all we're trying to do as systematic value investors in a nutshell. And if you want to make an analogy to, I guess, home buying, which is something that a lot of people might understand, is we don't want to try to buy the best house in a so-so neighborhood. We want to go focus on the neighborhood that nobody wants to hang out in. Everything's cheap, but we want to try to find the best house within that cheap neighborhood that's of highest quality. And it's not going to be a pretty house more often than not. That's why we're getting it so cheap. But at least it's, got the ability to maybe be valuable in the future. And we just got to look past all the ugliness and all the junk and all the short-term noise and really have a long-term horizon. Because in general, when you pay a lower price for something, you usually get to earn higher expected returns as a kind of a fundamental principle of economics.
Do you believe that there's an intrinsic value, I think is something that's interesting. Do you believe that, intrinsic value exists, or do you think that value is something that's going to be subjective?
I think it's definitely subjective, because a lot of times when you're trying to calculate intrinsic value and you're not just buying really cheap stuff that everybody hates, where it's clear, hey, this makes a lot of cash flow, I don't have to pay a lot for it. A lot could go wrong. And I could still be right. Whereas intrinsic value a lot of times includes estimations of long-term growth potential, margin potential, and all these other things. And those tend to be subject to heavy sentiment. So, for example, just fast forward the clock 2 years ago, what's the intrinsic value of the tech sector? Well, everyone's going to be like, well, I anticipate that it's going to grow at 50% a year and my gross margins are going to continue to expand. And you could get these insane valuations that are quote unquote the intrinsic value. And now, not because fundamentally the world shifted, but just because sentiments have changed so much, those same intrinsic value calculations are like, well, actually, I don't know about this growth. I don't know about this idea that we're actually going to make profits and we weren't just buying revenues with like VC money. This is actually not worth anything. So I just feel like intrinsic value is much more subject to sentiment waves and behavioral bias and therefore dangerous. Whereas just systematic value investing, where we're just going to go buy cheap stuff that makes money, that just seems like a principle that is pretty low risk in the long run. And that's why we focus on that in particular.
Yeah. And thinking about value investing in general, similar to, and I use this kind of analogy and joke earlier with you, but it was like, there's so many different ways to measure value. It's almost like you go to I love ice cream, have since I was a little kid. My boys like ice cream. So we'll go grab ice cream, tons of different flavors. Some of them you're going to really like and others you're not. And some are better. Again, you can say that, hey, there's subjectivity to that, but there was a paper that was done and I'm going to forget, but there was thousands of ways to measure value. Yeah. So you have done a lot of the research in that space. How do you break it down? And is there a quote unquote best way to measure value? And what does that look like?
Yeah. So I don't really believe in any best way, but the thing about investing, I think the most important part is understanding what you're buying and why, like almost just common sense. Like take the data, take the quantitative back testing out of the way, because a lot of times that can cloud judgment. And let's just focus on a first principles basis of what are we trying to achieve. So when I'm value investing, throwing all back tests away, what do I want to do? I want to focus on the area of the market with the cheapest companies, because I believe that on average, if you pay low prices for cash flows, that's a winning trade over the long haul. And even if things aren't that pretty, even if a lot of things go wrong, if you pay a really cheap price for something, you got what they call a margin of safety, which is this Ben Graham, who wrote this book called Intelligent Investor, always talked about, and it's a principle that he wrote about 50 years ago. It's still relevant to today. So that's the first principle. Buy cheap stuff for less than they're generating. And it's a question of like, well, what the heck does that mean? And so one of the things I would just think as a business owner, because most business people who don't know anything about financial statement analysis or really any of the weeds, you just think about, okay, if I have a business, what happens? Well, I have revenue and then I have cost of goods sold, right? I have to buy the inputs that produce the widget so I can sell to make the revenue. So I got revenue minus the cost of goods sold. And then I have selling, general, and administrative. I have to pay the secretary. I got to pay the rent. I got to pay myself some salary to for the fixed costs. That ends up being what they call operating income, or earnings before interest and taxes, right? That's like operating income, right? That's what the business actually makes. So regardless of how the business is capitalized, but whether it's equity or debt, that's just brain dead business 101. Revenue minus the cost of goods sold minus the overhead cost. That's what this business eats and generates. We like that number, and that's why we use that when we're first assessing value, is what is the operating company of all these companies that we're looking at, what is the operating income of all these companies we're looking at? It's very simple, very straightforward, and very business focused. And then the next question is, great, what do I got to pay to buy the assets that produce that operating income? So in order to produce that income, I now have to buy the capital structure that generates it, right? I have to buy the equity. I might have to buy the debt. But I can also, if there's any cash in the bank account, I could throw that back in my pocket. It's called enterprise value, basically, right? But if you don't know what enterprise value is, who cares? It's just what generated the operating income and what do I got to pay to buy all the assets that generated it. And then I'm going to go look at all companies in the business world out there. What are they generating operating income? What do I got to pay to acquire that operating income? I want to focus on the cheapest ones possible, right? And if I can earn 20% operating income for the assets paid, that's pretty good earnings yield, right? Because if I just was not in the stock market and I thought of it as a business, technically that operating income I could just take and I could distribute all of it, right? As an owner of the assets. And if I can buy businesses for 20% yield, that's a lot better than buying assets for a negative yield, i.e. they don't even make money, or like paying 4% yield, because I could go put my money in a 1-year CD and make 5% right now. So that's just how I think about it fundamentally, is just operating income over what do I got to pay to buy the operating income. And the fancy term for that is EBIT to EV yield or enterprise multiples. And that's what private equity owners typically use when they're out there purchasing businesses. So we focus on that as a first principle idea. And it turns out that now that we get into the backtest world, like that's our first principle of why would this work? Does that make sense? Yes. Okay. How does it look in theory? Oh, it holds up. And in fact, it's actually one of the better measures. And anytime you have something like that where common sense prevailed initially, and then the out of sample scientific experimentation to validate, does it actually work? If that also shows up, well, hey, we're going to like that idea because it's probably grounded in a lot of theory and a lot of truth.
Yeah. Makes sense, right? Like ultimately, what is the business's purpose in existence? Usually it is to make something and sell something. Are there industries? Because I think this is one, and it's a little leading question because I kind of know a little bit, right, about some of the things that you all do. But you talked about like a widget. Well, there's going to be certain businesses that maybe don't have a widget. So maybe they're more service based, or let's use financials are obviously in the news right now with Silvergate and SVB and Signature Bank and all those. Like how do you factor in other kinds of businesses? The widget makes a little bit of sense, but there's going to be certain businesses that are a little harder.
Yes, for 100%. So again, our principle of value investing is let's go find the cheapest stuff, which we feel we can analyze as just a business. And that gets back to operating income over enterprise value. And then the next component of that is assessing quality. And that's just common sense, right? Are you making money? Are you paying down debt? Are you not super levered? Are you buying back stock? Like all the first principles of like just a quality business we need to have in hand. Well, as you can imagine, there's a lot of different industries out there. And the financial services industry in particular is highly interesting because the problem with that business is it's unlike any other business in the world where by design, you're buying into an organization that by construction is always a highly levered business that lives on a knife's edge between existing and not existing. And so anytime you use kind of first principles of business valuation and you look at first principles of quality assessment, a bank just looks like an over-levered business that could go bankrupt at any moment's notice. And fundamentally, that makes sense because that is what happens to banks as we're seeing in real time. And so if you try to use standard valuation tools to assess a bank like we do, they just don't really apply because they're never going to look like they're high quality businesses. They're always going to look like they could go bankrupt any moment's notice, which happens to happen all the time, right? And so because our systems and the way we approach that market, it's just not relevant. We don't use the tools to try to assess something where the tools don't work. So financials, we just don't look at. You need to build very customized, specialized valuation frameworks and tools, in our opinion, to assess that particular unique niche market. But outside of the financial industry, where the quality metrics just don't make sense because they're highly leveraged by design, and even EBIT doesn't make sense because the cost of goods sold is interest. You can't apply operating income in the context of a bank. That's for other people to think about. We don't do it. We're just going to look at all the other operating businesses out in the world. And so that's financials in particular. But it also brings up a good question: is there's other ways that people use tools to identify value? I spoke at it from a first principles basis of I'm just a business owner. What's my revenue? What's my cost of goods sold? What's my SG&A? That's my operating income. That's what the cookie, stand actually generates. What I got to pay for it. Pretty simple. Other people might look at things like, well, what's like the book value of the business? How much have I invested historically and technically if I liquidated the assets, what would this thing be worth? So you could do that approach as well. The problem is, what if you're a business, to your point, that's a service business like Google or Facebook and all these kind of business? They don't have any book value, right? Because they didn't buy capital assets, right? It was all intellectual property. It's all trademarks. They don't have any book value. And so the problem with other ways that people look at value is it's not grounded in first principles, in my opinion. And you can a lot of times buy companies that have amazing book value and have horrific operating income. In fact, they lose money. Like a lot of systems, if you were looking at them a year ago that are based on book to market, 30 to 40% of the underlying companies didn't even make money. To me, as a business owner, how is any business that doesn't make any money a value investment? No, that's a dirt ball, money losing garbage dumpster fire. That's a lot of risk. I don't want to get anywhere near that, right? So again, going back to the idea, first principles, focus on operating income and make sure we can assess it correctly. And then on the second stage, assess quality just for good old blocking and tackling quality metrics. Those are the type of securities that we want to analyze because that's just a business owner perspective. And that means we're going to exclude banks because we can't use our tools on them. And that means we're not going to be focused on other ways to assess value if they just don't make sense to me on a common sense basis. And that's just how we go about it.
Makes sense. Wes, so if I'm a listener and I'm like, yeah, this makes sense. Why doesn't everyone do this? And then if everyone does it, is it still work? Right? Like that's the ultimate question.
Yes.
And why doesn't everyone look at it this way?
So going back, literally, this is a funny experiment. So, we had to write a whole book about this. So if you go back literally 100 years ago, like Ben Graham has this very simple strategy. He's like, go buy low PE stocks. And I think he has some like debt to equity basics, right? Because he's like, hey, go buy really cheap stuff, but make sure it's not highly levered and could go bankrupt on a moment's notice. It's the most brain dead systematic value strategy ever. It's basically like quantitative value, right? And he does this back test from like 1927 to like 1970. And sure enough, what happens? Well, you beat the market by a ton, but it's also really volatile. And along that route, you look like an idiot for potentially 5 to 10 year runs, right? The general market might be doing really well. You're just in the doldrums looking like a bonehead. But if you were able to do that over a long horizon, you end up like doubling the market return and you might have a little bit higher volatility. But anyone who like just came down to planet Earth would be like, well, I want that one, not that other one, if I was a long-term investor. But of course, not everyone's a long-term investor, and every year they're going to be looking at like, well, how'd you do relative to this S&P thing or whatever it is that happens to be your benchmark? And sure enough, it's going to do well over the long haul. In fact, it doubled the return. But in any given short time window, you could have looked like a total bonehead. And of course, we redid the whole thing from 1972 all the way up to whenever we wrote Quantitative Value. I think we published it in 2012. So another like 40-year out of sample. It's literally the same exact result. Double the market return, a little bit higher volatility. Why wouldn't you do that? But, oh, by the way, you could go through these 5-10 year windows where the S&P just crushes your soul and you look like the biggest idiot on the planet Earth, right? And so in the end, if you're doing strategies that are just fundamentally focused on the first principle, let's just go buy the cheapest stuff out there that everybody hates, but make sure it's of high quality. That is a strategy that on a first principle basis and in a back testing sense is generally going to earn higher expected returns with similar volatility over the long haul. However, it's going to have this massive, insane pain point that it requires discipline and the ability to have long-term horizon. Because if you, for some reason, incorporate relative performance in a short horizon window into your calculus of is this a good strategy or not, it's going to be one of the worst things you've probably ever done in your life. And everyone wants to say like, well, why would I care I just care about like doubling the market return. That would be pretty awesome. And I've got long horizon. I can deal with the relative pain because I don't care what the neighbor's house looks like. I just care about my house and how squared away it is. The reality is of the marketplace, as we all know, is that does seep into your calculus. So the reason I believe fundamentally that just systematic deep value works is it's an open secret. Buy cheap stuff that's high quality, but it's also an open secret that you're going to not want to do this many times over throughout the strategy. And typically you're going to want to get rid of it at exact time when it starts working again. And unfortunately, as you know, we've been saying this ever since we've launched our systematic value strategies, which we've been doing for almost over 10 years now. And we launched in 2012 and it had a great run, right? 2012, 2013, amazing. And then we launched more public products, which I'm not going to name here, but you could go do your own research. And that was kind of like at the peak of when they all of a sudden just started doing terribly. And up until a couple of years ago, it was pretty much the worst thing you could do. Hey, let's focus on cash flows and buying cheap stocks that are high quality. that seems like a good idea. But meanwhile, the market thought it was a better idea to buy way overvalued stuff that doesn't make any money that sounds cool. That was, again, value investing was the worst trade of all time, except for maybe the last year and a half, where all of a sudden sentiment shifted. All of a sudden, buying cheap things that are high quality became cool again, and buying way overvalued growth companies that have no money, have no plan of making money, have lost 80%. And all of a sudden, we're the cool guys again. But so it works, right? If you just do the strategy and you buy cheap stuff that's high quality with conviction, it's going to work over the next 20 years with a high probability, in my opinion. But you're going to have to live through these periods that we've seen in real time aren't always pretty, favorable.
Yeah,
that's why it works.
I was going to say, going back to the story at the beginning, right? No pain, no gain. So you have to really just put up with getting punched in the face over and over again for a long time.
Exactly. And we even say that today, like right now, value is probably set up on a go forward basis to have kind of one of its best relative performance runs of all time. Because, like, for example, right now you can buy really cheap stock portfolios, for example, over 20-25% return on your money, right? Operating income yields are 20-25%. So if you could go buy a business today and you could earn 25%, if you just said, hey, we're just going to distribute all the income out to the owner, you'd be like, wow, that's amazing. Whereas if you buy the S&P, it's more like you're buying that same thing, but you earn 4% or 5% return on your money. That's pretty risky. And you could do that right now. And that spread where you can get 20-25% operating income yields, whereas if you just buy the broad passive market, you get like a 5-time spread. That's something that is very rare and doesn't hang out for a long time, because eventually gravity has to matter. And if you can get 5 times the yield on your money, people eventually wake up and think, wow, that's a good idea. And that spread will compress. And we're at that point where it just seems like the opportunity of value and the spreads you can earn in buying cheap stocks versus the passive market is epic over the long haul. But of course, the caveat is that spread, these spreads can always get a lot bigger before they actually converge. And so, and that's why it's always so important to just have like that 5, 10, 20-year horizon on these things. Because in the short run, as we know, and we've seen in real time, just even in the last few days, the market's just crazy in the short run. And none of us can tell it what to do. And you just got to be able to survive those transition periods on all these kind of edge trades over the long haul.
Yeah. And I was going to ask kind of the setup, because talking to some of the other members of your team, that's something that's been highlighted a couple times, like value's looking really attractive based on a lot of other pieces. You want to touch on so Jack talked about momentum. You guys have momentum and value. How do those kind of work together or differently if you pair them together? I think that's an interesting kind of topic as well.
So there's really, in the end, there's, in my opinion, I think I've solved this. There's 2 core religions in the financial marketplace. There's the fundamental Ben Graham, read balance sheets, like businesses matter religion. And it doesn't really incorporate sentiment. It just says, oh, that sentiment, those technical people, those weirdos that live in Palo Alto that do this stuff, like they don't really matter. All that matters is like the balance sheet and income statement. That drives everything in the marketplace. And a lot of people in the real world are like, well, that's kind of crazy. Like my neighbor's an idiot and he's day trading all day long. So that can't be the only religion, but that's just one religion. And then you got this other religion of like the technical analysis, momentum, trend, where they say, you know what, these old school fuddy-duddy, pay attention to the fundamentals people, they're wrong. The only thing that matters is sentiment. What do people feel? What are the animal spirits doing? And we're just going to follow that shiny rock crowd to the promised land, because momentum begets momentum, trend begets momentum, and fundamentals be damned. And that's its own religion. And, so one religion of fundamentals, gravity, income balance sheet, kind of geek, CFA types, they think the other religion is totally wrong, totally misguided, and they're just cuckoo, right? And then you got the technical analysis, sentiment focused. They think these fuddy-duddy, stick-in-the-mud people are just cuckoo because they can't see the light of the future. They don't realize that sentiment does drive market. I used to be in the religious camp of value fundamentals because that's just kind of what was always intuitive to me. And it took me a long time to realize that the best religion is to not be stuck on one religion. We should believe in multiple religions and just take the best ideas from both, right? And so value investing is firmly rooted in fundamentals, gravity, balance sheets, income statements, common sense on that sense. Momentum investing says, nope, we're throwing all that away. We're actually going to believe in sentiment. We're going to believe in animal spirits. We're going to believe in shiny rock chasers as a fundamental driver of what the marketplace does. And I'm firmly convinced that both religions are right. They're just probably right at different times. And so instead of just betting on one religion and when it's going to be right, I'm just going to bet on both religions and take advantage of the fact that they tend to kind of cancel each other out at times. And presumably if I buy some value stuff, that makes sense to me. I buy some momentum stuff, that also actually makes sense to me because from that religion perspective. And I might get the benefit that when one of them's working, the other one's probably not working. And I kind of get some diversification benefits. And to the extent you want to have a smoother path, because that might be valuable to you from a portfolio perspective, you might want to do that. Now, in fairness, if you just didn't care about a smoother path and you're like, man, whatever, I got 20 years, I'm never going to open my statement anyways. Well, maybe you might just do the value religion because you're comfortable with it, or you might just do the momentum religion because you're comfortable with it. But if you do value any sort of diversification or kind of path smoothness, you might want to consider using both elements of the religions because I think they're both interesting.
Yeah, love that. You talked a little bit about Warren Buffett. You talked about Ben Graham. Who's a value investor that is not famous enough that you've either learned from or read or really enjoyed the work that they've done that doesn't get enough credibility out there?
Trying to think. Probably, honestly, it's probably like a lot of the academics like Fama and all those guys like Eugene Fama, who used to be my old advisor, and just all those models, like those factor models on just what they call HML, like high minus low, like the value factor. And before then, there was people that talked about like the PE factor. But I think kind of like the new age, well, not new age, but I guess in the 90s, which is now 30 years ago. But I'd say like Fama and French and another group, Leconstruct, Schleifer, and Vishny, they're referred to as LSV in the academic literature. Like Fama kind of brought up this idea that like, hey, systematic value makes sense and you should be a value investor. Of course, I believe that it's all risk-based is one story. And then Leconstruct, Schleifer, and Vishny, who most people don't know, that they have a firm called LSV Asset Management, which is pretty big, but it's not as famous as DFA. They're also at the same time kind of the academic religion of value, where they said, well, we think you should be a value investor, not because we think it's more risk-based, but because we think people are crazy and they generally throw the baby out the bathwater. I think they're also should be up there on the pedestal of kind of making it, evidence-based academic first principles argument for value investing that most people don't know about because they're not reading the Journal of Finance all day, which is probably a reasonable, I don't recommend that either, even though I do that, but most people aren't as crazy as me. And, so you're probably not familiar with Leconstruct, Schleifer, Vishny, but I'd Google them. They're super interesting people that laid the foundation for why you'd want to invest in value over the long haul. Yeah.
Thank you for that. What do you think about the claims that value investing has died? Again, I know you've kind of addressed it, that you just need to be able to absorb punches, but when and how would you ever change your mind, right? Going back to that stick in the mud.
So the problem is, if you think about it, like in the end, I think after doing this for so long, I've kind of figured out the answer. And the answer is always simple, right? The fundamental first principle of the marketplace is no pain, no gain. And so what we need to understand is, well, what is the pain tied to any strategy, and in value, what is the pain? We can have arguments about this, but there's two arguments that have been deeply argued for now 50 years. One element of the pain is when you buy value companies, you are buying things that are out of favor, probably more subject to fundamental macroeconomic risk. That's why they're selling at 25% operating income yields and not 5% operating income yields. So it probably is true that Kohl's, who's a retailer with hard stores, is different fundamentally than Amazon. But they can adjust, they can adapt. It's not like they just sit there and die. That's what people don't understand about value stocks. You have this huge margin of safety where they get to adapt, but you get paid a 20% excess yield in the meantime And as long as they're not too terrible, you still win. But there is fundamental risk. And as long as you believe that fundamentally value stocks probably have some element of true risk to them, you should earn a higher return, right? And then the other component is the behavioral side of it, the career risk side of it, and the fact that in general, the market is short horizon. They see the energy stock 2 years ago and they're like, oh, this thing will never make money. What a low life, loser business where you're going to drill for oil and just make money all day. That's kind of stupid because solar panels are going to take you out. And yeah, that might be true 50 years from now, but those firms can also adapt. But this idea that people just throw the baby out with the bathwater. They always think in the short run, this is ugly. And because sentiments are driving that thing to everything that does this is ugly. I want to go in the tech stuff or the new shiny rock of the day. And so you're going to earn this premium, I think, from just bad behavior. People misprice bad news and they always push it way below what it fundamentally should be worth because they got myopic or short horizons. They can't think beyond, 5-10 years. And so as long as you believe that, and also, by the way, in order to exploit that mispricing, you need to hold these stupid strategies in the middle of a sentiment wave. And it's very challenging to own, for example, 2 years ago, hey, I'm going to go in an energy patch because they make a lot of money and they seem to be bucking the trend and they're really high quality firms. But even in the face of everyone saying, well, that's Loserville, that's, they're going bankrupt, solar panels are going to take them out. The whole point of going against the trend of behavior and sentiment is that's really painful because you have to go against behavior, which is ingrained in all of our minds and it's in the ecosystem. So value the fundamental principles of the pain, or you've got to go against sentiment, which is telling everything in the world is telling you you're an idiot. And you also got to generally probably take on additional risk. And so fundamentally, as long as deep value strategies are constructed to load up on as much as risk and mispricing and pain as humanly possible, it makes sense that they should earn some sort of excess return out of sample. And so the only thing that would make me not think that is for some reason, people just don't care about fundamental risk. And they're like, yeah, it's riskier, but I'll just get the same payment for that. Or they don't become humans anymore. And they're like, well, I'm not going to pay attention to the news. I'm not going to pay attention to Twitter all day. I'm actually going to be like Warren Buffett and have nice 10-year outlooks on everything and be super rational. And I just don't see anything in the ecosystem that would suggest that would ever change. But those would be the two things. People just got crazy and stopped pricing risk. Might be possible. I don't see any evidence of that. Or humans just stop being humans. At this point, that's how grounded in the first principles of value and why it works I am. I just think it will always work because humans are not going to change. And the first principle of markets have to allocate risk and reward. And I just think the market's somewhat efficient. No amount of data, I have to live out a sample for another 100 years to even be convinced otherwise at this point. I just think it's going to work on the principles of human nature at this point.
Yep. What haven't we or I talked about or asked on value investing that I think is important? Anything we haven't touched on? Or any closing thoughts on that?
No, I think, I would say that the number one thing that's important about value investing, or really any sort of investing you're going to do, for example, I see your Bitcoin sign back there. All investing is good investing. You just have to understand what you own and why. Because if you're doing an investment that's going to earn excess returns, whether it's Bitcoin or whether it's buying, energy patch stocks, or it doesn't really matter. Understand what you own and why, and make sure it is firmly grounded in first principles and tied to your beliefs. Because I can tell, I do it the way I believe because I put my own capital in these things. And so, I'm along for the ride. So I got to make sure I believe and I understand what I'm investing in and why, because at some point you will be tested, guaranteed, on your thesis. And the worst investors are the ones that think they're disciplined. They think they understood what they were doing and why, but they didn't really, because they will get pivoted off the X at the worst possible time and say, well, the world's changed. Things are different. And that's because they're humans. And so we just need to make sure on whatever we're doing, whatever investment we're doing, what is the first principle? What are we investing in and why? And what everyone else has to say about it can go to hell. And you almost need to build a system, like you need to build your system. But at some point, weirdly enough, you need to become religious about your investment process, because if you're not religious and you don't have faith in the first principle, you eventually, if you don't have faith, you're going to capitulate. And that's going to be at the exact time when you're going to probably get to earn all the risk premia that you set your faith in the first place. So whatever you're doing, that's a much more a meta concept, but it's just at a 40,000 foot view. If you apply that principle and eventually establish faith tied to first principles, and you really understand what you're doing and why, you cannot go wrong in investing over the long haul.
Yep. And I think an important lesson is you can't borrow someone else's conviction, right? I can't borrow Wes's conviction on why value investing works. Like you have to put in the work to understand the why behind it. And that's something that's really important. And
and that's why our firm mission is to empower investors through education. Our firm mission is to not generate whiz bang alpha, blah, blah, blah. Because to your point, I can have a lot of conviction and a lot of shit and make the best product that was ever made on the planet Earth. But if you don't have the conviction because you haven't invested in the education, understanding of first principles of why is this a good idea, none of that matters. Yeah. So you got to understand what you're buying and why, even if you're hiring advisors, intermediaries to help you guide yourself on that journey. You still need to understand what you're doing and why, and everybody does. Otherwise, none of this stuff really works in the end.
Yeah, I think the highlight of this is the value investors and anyone that saves or puts money into Bitcoin both have to get punched in the face for a long time and look like an idiot. And I think that actually is very interesting to think about that corollary between the two. But
I know. It is. It's the Bitcoin thesis. I mean, not that we need to go on to that world, but I mean, that obviously has it's very different obviously than the value thesis, but there is a firm first principles thesis that a lot of people have there. And to the extent you believe in that 20-year thesis and that's your first principles, and you have a lot of reasons to be convinced that that's the path forward, there's going to be a lot of things that go wrong, many of which have happened here in real time, has always happened, for you're going to maybe lose faith in what you're going after. But if you maintain that 20-year horizon and you recheck the reasons why you believe in the first principles of why this might work, you just got to stick with it. And of course, value investing, I believe in first principles. I invest in it, but I don't go 100% in value investing. I don't go 100% momentum. I don't go 100% Bitcoin, but every single thing I invest in, I want to understand the why and how of what we're doing and what's the first principles of why we're doing this in the first place. And getting back, let's make fun of people. So a lot of people just go buy Vanguard funds. They're like, oh, let's just go buy this Vanguard fund. It just buys everything. And we're not going to do any due diligence. We're not going to think about any first principles of how and why. We're just going to do it because it's cheap. Buying stuff on low cost and affordability is a great first principle, but you still need to understand what you're investing in. And what if the S&P 500, if you actually thought about it on a look-through basis, was an overpriced turd that was just fundamentally a bad company that you paid way too much for? Even though the price might be free, does it make sense from a first principles standpoint to overpay for something that's really fundamentally not that high quality? Most people with common sense would say no. Just because it's free doesn't mean it's a good deal. But you see that kind of attitude about everything in the marketplace. And again, I'm not saying this to say that buying Vanguard funds is a bad idea. I'm just highlighting that sometimes you should understand what you're buying and why, because even if something is free, but fundamentally what you're buying is way overpriced and not that high quality, that's a terrible idea on a first principle standpoint. And if you need to do it because you need to track the index, you're incurring a massive cost and a massive risk by avoiding all due diligence on just knowing what you're buying and why. And I think there's way too many people in the marketplace do that on a daily basis. And I think it's personally insane. I understand why they do it because of career risk objectives, but it's something that everyone should ask themselves. Well, you know this, but like clients, especially if you're working with advisors, should be asking that question. Because a lot of times the advisor has to placate a client's terrible behavior because they're forcing the intermediary to make a bad decision and think like, well, I'm just going to have to do this for career risk because if I don't track the index and just do what everyone is doing, I'm going to look like an idiot. But the more that clients say like, well, why are we doing this? What's the first principles? Like, do I really want to own the S&P if I thought of it as a true investment? And if the answer is no, well, then why are we allocating 80% to that? Maybe that's a bad idea. And so I think the more that the first principles flow down to even like the bare bones of like the actual client who owns the capital, that would make everyone's life a lot better. And we could have transparent discussions about this more often than we probably do right now. So.
Yeah, that's a lot of wisdom in that. I appreciate that. And yeah, I think the key thing is understand what you own. And the biggest challenge that I see with people when we have conversations on investing, if they work with another advisor or they do it themselves, is like, I don't want it to be a black box. And like, we want to be able to educate the same way so that you don't have to be the expert. You don't have to spend, thousands of hours to go through this because maybe that's not interesting. And there's a reason why you want to outsource it, but there should be a rationale for the why. And I think that's key. But real quick, before we go, where can people learn more? How do they connect? How can they read some of the stuff that you all put out? Where would you give them a handoff to?
Yep. So alphaarchitect.com, we have our blog there. You can subscribe. It's free. We usually produce like 2 to 3 articles a week. We're trying to synthesize academic research and make it digestible for normal people. Sometimes it's not, but we try our best. And then on Twitter, my handle is Alpha Architect. So that was easy. And then we got Ryan, Jess, Jack. We have a whole bunch of people you can follow. But basically, alphaarchitect.com, sign up for the blog, or Twitter/alphaarchitect. And you can follow us there as well.
I appreciate it. Wes, thank you so much for the time. This was great.
Yep. You got it, Isaiah. Appreciate the time.